Let's talk bonds. And I'm going to start off by saying that as far as the Treasury market is concerned, the technical picture shows one of the most oversold conditions in modern times. And what I'm talking about specifically in this case is where the spot yield on the 10-year Treasury note is at 2.93%, as I said, is now a whopping 122 basis points above the 200-day moving average. What is that? Well, it is a 2 standard deviation event. And I can tell you that yield spasms like what we've witnessed in the past few weeks and past few months, which typically occur in Fed tightening cycles, have foreshadowed a recession in the past more than 70% of the time. And when they don't, they've occurred in some very tough periods for the equity market. For example, the fall of 1987, the summer of 1994, both episodes that were followed, by the way, by mammoth Treasury market rallies. And we can take another clue from what's happening in the equity market, insofar as the sectors and the subsectors that are most sensitive to market interest rates and domestic economic activity are breaking down across a broad front. Home furnishing stocks down 46% from the peaks. Consumer electronics down 37%. We have the home builders down 30%, and we have media entertainment stocks down 30%. The retailing stocks down 17%. So these are vivid signs to me of the stock market telling all of us about consumer demand destruction. But the bond market hasn't repriced for this just yet. It has inflation on the brain. Even consumer cyclical services, which are the poster child for the reopening trade, they're down 12%. They are in an official correction. The trucking stocks down 22%. The rails are down almost 10%, so they are in an official correction mode as well. And so for treasuries, all of this needs to start showing up in durable signs of economic weakness in the data. I have to say that the fact that the S&P 500, again, looking at what the stock market is telling us, that the employment services subsector is now down 7% from its highs, well, that is a telltale sign that we are on the precipice of seeing a softer underbelly take hold in the labor market. And so, yes, the Fed clearly committed to 250 basis point rate hikes in May and June, and sounding oh so tough right now. But I think we're actually peaking out on this score in terms of Fed hawkishness. This to the Fed is all about a credibility game. Meanwhile, you would think that with all the inflation chatter and all the inflation narrative, that the inflation currencies would be breaking out. But that hasn't been the case. And you would think that the stock market would be on board, but you see the poster child for inflation in the S&P 500 are the basic material stocks. And they haven't made a new cycle high since December 31st. And this is what a whole lot of people missed in the March data flow, which was a flip in the domestic demand-supply imbalance. We got 2 data points last week for March, which I found to be very encouraging. Keeping in mind, it's all about supply and demand. So you see, back in April of 2021, at the peak of the fiscal and monetary stimulus, and of course, all the supply bottlenecks, the year-over-year trend in real retail sales outpaced the year-over-year trend in industrial production, the supply side of the economy, by a record 30 percentage points. And that is what ushered in this current era of sharply higher inflation. But the demand-supply imbalance, at least in the goods sector, is being resolved. So we saw last month, in March, things flip around. Industrial production growth in the United States is now running plus 5.5% year over year. That is bumping against retail sales volume growth of negative 1.6%. So a gap has opened up between supply and demand for the first time since April 2020. And that 7.1 percentage point gap between production and real sales growth has only happened to this extent a handful of times in the past. October 1997, January 1991, July 1981, March 1980, and guess what? Inflation came down materially a year later each and every time. So the message is this: the tables have turned. The question is when the Fed and when the bond market community is going to recognize it.